insight into strategies for both equity investing in also traditional loans. I will let everyone introduce themselves, starting with the far left.
Hello, my name is Tim Kelly. Does this work? Yep. I represent Canyon Angels. We are one of a handful of angel investor groups here in the Valley. We coordinate with Desert Angels, with ATI, with Thunderbird Angels, and several others. I teach entrepreneurship at Grand Canyon University. I have a couple of small businesses. My wife and I have Spanish immersion preschools called Little Big Minds around the Valley, along with a few other businesses that we have, and I'm excited to be here.
Hi, I'm Craig Jordan. I'm with the U.S. Small Business Administration. We have counseling and business development programs, and actually Jay was talking about one of them called SCORE. We also have Small Business Development Centers, Women's Business Centers, and Veterans Business Opportunity Centers that can help you by looking at your financial position one-on-one and actually going through your books, figuring out what your financial position looks like, addressing what your lending capabilities are going to be for your organization before you approach the banks. We also do a clinic. It explains how this all works because it is complicated. We're going to try to simplify it for you. But sometimes you're going to need to have a couple of different options rather than one option. And we can help you just by getting you educated and getting you put in touch with people that are experts in the field of accessing capital.
Good morning. My name is Jose Martinez. I am with Casamo CDFI. So we are a lender for small businesses. We're not a bank. In fact, where we fit is where the banks can't or are unable to do a loan for a small business. So that includes startups, those businesses with not enough years of history or other circumstances where they wouldn't be able to get a loan from a bank. We've got a number of products. One that is a product that's an SBA product, a micro loan that's under $50,000. We have a product that is for loans $50,000 to up to $500,000, and on an exception basis will go to $1.5 million. And then we have a SBA Community Advantage program, which is a loan product, which is a loan up to $250,000, where there's not sufficient collateral in place to secure the loan. So those are the basic three products. And what we do, again, is lend to small business. We've deployed over $70 million to small businesses, primarily here in Arizona, some in our neighboring state of Nevada.
Good morning. My name is Roberto Valdez Beltran with Accion. And similarly to Jose's organization, we do micro lending at Accion, and we cover 5 states. Currently, our program does, including, of course, Arizona, New Mexico, Colorado, Nevada, and Texas. And we're part of a larger microfinance network we call the Accion Network, based out of New York. There are about 4 sister programs around the country. We're one of those, and as a network, we've lent over $500 million in Arizona alone. Spent a little bit over $20 million since late 2008 when we started lending in Arizona. And we focus on smaller transactions. Typically, our bread and butter lending happens on average for loans of $15,000 to $17,000. So we do a lot of micro lending for startups. We've done, maybe in Arizona, it's about 45% of the lending has gone to startups. And we started at $1,000. That's the minimum loan amount we do, which is very small. And we may go up to $1 million. So there is a wide range of opportunities. We started doing more commercial larger loans starting maybe 2012, because our banking partners kind of started pushing us like, you have to do more in this space. There's not a lot happening there, and we want to refer more. So Accion does have a product for that, but the majority of the lending happens below $100,000. We do SBA lending as well, but that's only the Community Advantage Loan Program, and that's up to $250,000. That would also apply for startups, and typically the minimum amount for those loans is $50,000. So anything less than $50,000, we would do it in-house or conventionally, non-SBA. and I'm happy to be here. Thank you. I'm the market manager for Accion. Been doing this for almost 9 years with them since we started the operation in Arizona and expanded into the Phoenix metro area formally in 2014.
Good morning. Good morning. Can you hear me?
Yes, sir.
My name is Clarence McAllister, based here in Phoenix. My wife, Wayne, and I started a company 17 years ago, in 2000, engineering construction company called Fortis Networks. Started with credit cards and a whole lot of equity. And to this day, we have over 100 employees, 30 million annual revenues, and we do projects worldwide. So we know what it takes to start a business, to get loans. And now we have multi-million dollars of lines of credit, and we do construction, so we have to bond multi-million dollar projects. So happy to be here. I'm also on the board of Accion, where I encourage the board at Accion to lend to individuals like me 17 years ago that didn't have access to capital. Now the banks want to come, they want me to be their customers. But back then, nobody wanted me to. So I'm happy to be here and share my experiences.
All right, let's jump right into it. What is the first thing a business owner needs to do if he or she expects to seek a loan in the next 3 to 6 months? Anyone?
I can start. So from the first 3 to 6 months, you said, right? So typically what we would ask is to come prepared with a business plan. Of course, if you don't have, you have to have a very long business plan, but if you have a good summarized version and a projection potentially for the first 2 to 3 years in the form of an income statement, there's a lot of resources out there because you would need support on building a business plan and or a projection. I know SBA does fund a lot of our partners, actually, the small business development centers. There is a SCORE group, and there's many resources online that I would recommend actually to look at the SBA website actually. So that would be the number one thing. I would also recommend for potential borrowers to look at their credit prior to meeting a lender. Even if it's bad, if you think it's bad, look at it, know what is in there, and come up with explanations, and try to work those out. We can draw a plan. It's not uncommon for us to sit down with borrowers and talk about a plan how to resolve those issues. We're not the experts necessarily in resolving credit issues, but we can tell because there's a lot of common situations that we look into that we can refer you out to a partner that may help you with those things. But I would say those two things: the credit, the business plan, and look at your credit, know what's in there, and know the story behind it, and of course come prepared to share your experiences, your background, why you want to start that business, because a lot of this, for microlenders at least, is based on experience and your character. So what do you want to do? Why is it that you want to accomplish something? And we want to understand the story behind the plan and the numbers. But so those are the things that I would recommend.
So I'm not going to add much to that, but I think it's a good opportunity just starting out. I'd like to get a sense of who's in the room in terms of, and not that everybody needs to introduce themselves, but if we can get a sense of where everybody's at from a business standpoint. How many of you are already in business and are running a business more than 3 years? Okay. And how many of you are, essentially in that first 3-year phase of your business? Okay. And then looking to start a new business. Okay. Great, thank you. So, okay, thank you. That's really helpful, and I think what we're talking to a group of folks that are looking to expand and grow their business, and that kind of helps us understand.
One more question.
Yeah,
How many in construction? Construction. One. Okay.
Yeah, good. Professional construction, okay. Professional services. Okay. And retail. Okay. Any restaurants? Okay. Good, yeah. So, oftentimes, we know the industries that, that the banks don't lend to, right? And oftentimes it's construction, it's restaurants. So, I mean, we've got a ton of restaurants out there, I'm sure we're the same. But anyways, that's a good way for us to understand how to best answer your question. Say,
All right.
yes.
Yes.
Just a quick question, you mentioned checking the credit. So
Yes.
do you look at the business credit or do you look at the personal credit? And what makes you make that determination?
Great question. That would depend on the time you have a business. If you have things reported on your business credit, we have the ability to pull that as well. But since we do require the personal guarantee, that's also important for you to know where's your credit at when you apply for a loan. Now, for microlenders, typically, we don't require for you to have perfect credit. I mean, Axiom, for example, our policy is the minimum credit score that we look at is 500. That's actually pretty low. So it doesn't mean that we would disqualify you automatically because you have a lower credit score. So it's a tier-based system, so we look into different options for our borrowers. But just to give you an idea.
Well, I'd like to add to that, the credit, the personal credit, my experience is when you start in the business, the first couple of years. Once you're established, then they look at the history of you as a business paying your bills, especially if you are LLC or corporation, that you have a history of good business practices. Because there is what's called the DNB, which is your business credit report. Now your personal, those at that point are separated. So initially it's your personal credit, and eventually, a couple of years, is your business credit.
Yeah, I'd like to add to that. I heard the last segment talking about personal guarantees and so forth. Now, starting out, that's going to be pretty much a requirement you're going to see everywhere you go. Ourselves as non-bank lenders, we're always going to ask for that personal guarantee, and almost no exceptions, on that. But I will say this, on the loans that we do, we report credit, and we report both personal credit and business credit. So it's one of those ways that you're able to establish, credit through your business. And so that is, that's the long-term goal for any business, is to be able to evolve, to grow out of being able, or having to do the personal guarantee. But just know that most banks and alternative lenders like ourselves are always going to require that on the front.
And I'm going to throw one more prep question in before we go to questions. What are the requirements, if any, when applying for venture capitalist or angel investor funding?
I'll take that one. my one customer up there. Angels, typically, they're accredited investors, which means high net worth individuals, income over usually $250,000, 2 years running, or net worth, excluding their home, of $1 million. In Arizona, there's about 100,000 people that meet that criteria. The little organizations we have that are called angel groups are just collections of those independent people coming together. Typically, what we're all looking for, and everybody's got totally different interests, and getting those all correlated together is impossible. But what we're typically looking for are early stage, high growth opportunities. These are companies that often have a technology play. It's kind of like Shark Tank. We just don't have piles of money on the table. But we are looking to take some form of ownership in your company, because we expect that if that opportunity is realized, there's an exponential return there. In our portfolios, if, I'll say the average angel investor, which is a dangerous thing to say, but the average angel investor maybe has 5 to 10 companies in their portfolio that they've invested in. Minimum investment is typically about $25,000. The companies in which we invest are typically valued between $2 to $5 million. So we're not taking a significant percentage. Normally, an individual investor would step in for a very minor percentage, your 0.5%, for example. And more often than not, they're not seeking a position on the board. They're expecting this to be somewhat of a passive investment. Some angels want to get involved. I might love aquaponics and say, I'm in, I got some buddies, I know the industry, which I don't, I'm sorry, but I want to be on your board because I think I can help leverage my relationships to make your business a success, and I'll come in for whatever X amount of your total raise. That's more or less a nutshell of how angel groups operate. We have about 40 members. Of those, 10 to 15 are active. We hear 12 pitches a year. That's it. We meet between September to April, and then we take 4 months off. And that's relatively normal for the angel groups. These guys kind of flee the heat, like to get away. So to match the timing of the interests of the individual investors with your need is really difficult.
How do you personally select who you're going to invest in?
So each angel group has their own screening process. So you can go to canyonangels.org. We have an entrepreneur section there, and you can apply and answer several questions about the market size and your connection to it, the idea, intellectual property, etc. We have a screening committee, myself, several other individuals that are actively involved, and I bring my students in. So we're not like the other angel groups that operate independently. We have students. So I have my entrepreneurial students working with me to evaluate each idea. And then we decide, we contact you, ask further questions, you come in, give a pitch. It would be a 5 to 15 minute pitch. And then we decide which of those groups that have pitched to us, that will select to be the final 3 to pitch at the end event.
Right. Yeah. So from that regard, how do you determine who you're going to have pitched to you in the first place? You know what I mean? Like,
right. It's got to be a high growth opportunity. And we want to see preferably firms beyond proof of concept. So of the 3 companies that will have pitched to us, we might have an industry focus, saying, all right, we're going to have 2 in healthcare and 1 in ed tech. Who knows? We might say cybersecurity is the focus for this session. We don't know. It's kind of random, whatever the group decides or whatever opportunities happen to approach at that point in time.
right.
And we'll also say, this is just for Canyon Angels, 2 of the 3 deals are syndicating. And what syndicating means is we're sharing these deals with other angel groups, not only in the Valley, but we have a treaty with Tech Coast Angels in California. We've got one with a group in Colorado. The reason we're doing that is because you entrepreneurs that need to raise $1 million, our little group's not going to do it. The only way we can expedite your efforts and facilitate your raise so that we all win is if we can share these deals with other angel groups. We call that syndication.
Yes. The timing piece of it. Like right now, you're here today. Thank God you're here. Glad you're here. But I'm saying you won't look at opportunity until September.
Correct. Well, I'll start screening in probably, I'll say August when I get back in town. The deals can hit me. If they're interesting, I'll forward them off. But I would not have you in our screening process until the first week of September, technically. If it's interesting, I can pass it along and we can see if it drops into other companies' groups, and then other angel group would take the lead. Most of us operate on the same software platform called Proceeder, so we can share deal information very easily. So if another group's timing works with your particular company and your interest is combined with theirs, go through their screening process, then they would introduce you into the system. You would pitch to them. Normally they'll video record it, and if we can get our technological asses together, then we can actually share all that with everybody else.
Right. Is there ever an opportunity where, or a chance where the angel groups and the lenders work together? Do you fund to a certain stage and then come in for more funding, or do you guys keep it all in house with the angels?
It's a bit of a different timing issue. And also, we're not really interested in micro-enterprise at all,
Right.
or one-off opportunities, like a restaurant. That's just not our interest. A construction company, it's not our interest. It's got to be some totally scalable, typically tech play. Venture funding, which is the next level up, there might be combinations of debt and equity. They're scored at later dates. Sometimes we'll do what we call a convertible note, where I'll give you a loan for $100,000. You're going to sign a personal guarantee on it. You're going to pledge interest on it, and then if your opportunity is realized, then I'm going to say, you know what, don't pay me back. I'll just take 10% of your company, or whatever the valuation might be.
And I could add a little bit to that. We, We also do equity, where we're primarily a lender, but we can do equity investments. We have done them in the form of convertible notes. We have done it in tandem, where we've provided some debt and some equity investment. For us, it's going to be about upside, particularly though in job creation, because we're a commission lender and we're looking to help create jobs. And so I can speak to an equity investment we did in southern Arizona, which was a battery manufacturer that had a lot of job creation involved. We were able to provide a $250,000 equity investment and some debt on top of that. So we can do that, but it's going to be about upside growth. But we'll look at that growth as job creation growth. And of course, we do look for a return on our investment, but it's going to be more friendly than venture capital for sure.
Right. And one last question, man. Do you ever do the angel money on concept? If it's a concept, try it and test it. If you got a concept, try it and test it. It ain't to market, it ain't booming business, but the concept's been tried, the concept's tested, and it's viable. Do you ever consider loans on that premise, if you can see the viability?
Well, not loans, but we might,
Right.
if the technology, for example, patents are filed, and you've got a beta test that you've run with several customers, and it's something that can be scaled, absolutely we look at that.
All right, I'll ask another question. What are some of the risk factors that anyone seeking a loan can reduce prior to making the loan application?
So for reducing the risk, we'll look at, well, several things. One is how much sweat equity you put in is one of the things, and if you put any assets already on the business, either from personal sources or you might have worked with other partners to do that. So that would reduce the risk from our end, because how we do it is, if it's a microloan, for example, of less than 100,000, we're most likely going to file a UCC1 blanket lien, and not necessarily going to have one-to-one value collateral, but if that specific asset, let's say it's a truck during construction, it would make or break the business. For us, that has more value. I mean, not only sentimental, but it does have a lot of value, because if that truck breaks, then that means that the business is not going to be able to operate properly. So for us, even if it's 50%, 40% coverage on collateral, it's important. So get to know what assets you have, the types of investments you already made in the business. It could be minor things, it could be larger equipment, but for us that's important, because that's one of the things that we'll look at on the risk scenario. So we want to make sure that we have something in collateral, but it doesn't have to be, like I said, 100% coverage.
I'll comment a little bit on reducing repayment risk, because really that's what these lenders want. They have to be able to show a trail of being able to repay. And so if you're starting a business and you're using projections to be able to repay that, one of the things that can mitigate those projections becoming likely would be a second source of income. Something that's not dependent on the business. So that might be you keep a part-time job. It might be that your spouse has an income, so that sets some of your personal. It could be that you have a membership model within your business, so even though you're projecting, you have contracts that say the minute that you open your doors, you have 100 members that are going to start paying you on a monthly basis. That would reduce your risk of projections. Having a contract would also do that. If you have a contract with an organization to purchase your product, that reduces your risk of repayment, right? So those are some things that you want to think about. And again, it comes down to having good coaching, somebody that does this, so they can look at your situation and figure out, based on what you have, what are the things we could use to reduce the risk of repayment. And those are just a couple of ideas that we talk about in the loan plan.
I'd echo something that Craig mentioned, the subscription model, where you have clients that are paying on a monthly basis, where the likelihood that they drop out can be demonstrated to be minimal. That's an awesome business model. We love that on the equity side.
Craig, can you speak to the SBA loan guarantees?
Okay, so I don't know how many of you know exactly how the SBA loan program works. We call it a loan program, but we don't actually loan money. We guarantee loans. So what we do, and you heard Roberto and Jose talk about the SBA program that they have, and it's basically a government guarantee. We guarantee the loans anywhere from 50 to 90%. It depends on which loan program, how much you're borrowing, but if you think about it, it's half to almost all. So it does mitigate a lot of risk. It mitigates a lot of risk for the lender and for the taxpayer. But what I tell the taxpayer is, what does it really do for you? It just makes the loan a little bit easier for you to get in the first place. That's really what it does, because the lenders get to exercise their own credit decisions for a majority of the decision. We do have some rules. You know, you need to be a small business. You know, you need to, have certain industries and things of that nature. But they get to make the majority of the credit decision. That's why when I spoke earlier, I said it's so important that you get good coaching, somebody that does this all the time, because there are so many different ways to finance your business, especially now. I mean, there's the online models, where you got online brokerage. There's the crowdfunding. There's equity. There's all these different ways you can finance your particular project. And as you heard, sometimes you can use debt, sometimes you can use equity, sometimes you can use merchant credit, sometimes depending on what your business does. You might be able to get all the credit you need with your vendors, and it might be under good terms as long as you negotiate that with them. You wouldn't even need a loan, right? So you need to have somebody that's on your side in your board of directors, so to speak, or somebody that you can go to that does this all the time to coach you to make sure that you're getting the right type of capital, that you're exploring all of your options, and you're getting good financing based on what your actual situation is.
If I can double down on what he's saying, crowdfunding is an awesome tool right now. You can even scale it up into millions of dollars through groups like AngelList. But crowdfunding is a great way for you to get money, essentially pre-selling your product. It validates your market, and you then, when you literally roll out your launch, you've already validated monies from your customers where you don't have to go to the bank. You can bypass the traditional fundraising mechanisms with angels and banks entirely and have your customers fund your business. Awesome.
Yeah, and I'd like to speak a little bit to crowdfunding. We will look at that, particularly when it's a startup and the client doesn't have enough dollars to inject into the business to start it up. And we'll look at crowdfunding as a way that there's interest in their business, there's support for their business, and a way that if they can raise those dollars through many, many individuals that are going to support that business in the long run, shows some of the proof of concept prior to launch, but also helps us in terms of being able to demonstrate that there is an infusion of capital at that startup place that we can then lend on top of.
It's almost becoming a necessary step.
In
a lot of
many
cases,
cases,
One of the panelists mentioned board of directors, and we small businesses, we underestimate board of directors. You don't have to be a public company to have board of directors. I've had an advisory board of directors for about 4 or 5 years now. So these are individuals in the community, could be a banker, could be an attorney, could be a CPA, that I bring to my office, to my company, 3-4 times a year. And I share my financial information with them. I let them know where we are, where we want to be, and ask for their advice. And that's a good resource to put you on the track to get a good loan and to grow your company.
There's a question in the back.
No, I was just wondering if you talk about the crowdfunding and that whole piece, is that going to be, you saying it's almost a prerequisite now, right?
It's becoming.
Right. So is that going to be a component for the SBA? Is it going to be incorporated in any component?
Yeah, it would be used as basically an injection.
But I don't think the SBA is going to see it as a minimal requirement. If that's, it's just becoming more and more common, I think, and particularly where there's not, ability to inject capital by the principals that are starting the company. I think that's where it evens the playing field a little bit, where not all high wealth individuals, are starting companies these days, and so this is a way to inject capital. So it's not a requirement.
Kickstarter.com is one, GoFundMe is another.
Yeah, but I was just curious if you're gonna have some experts in those areas about jumping off with Kickstarter or any of those things. Is the SBA gonna have somebody at some point to say, we'll help you get Kickstarter, we'll help you do some of those things?
There's a great book called Bold by Peter DiMundis.
It's probably not the answer you want to hear, but because they're not governed by SBA, don't have lending relationships with SBA, you'd have to do your own vetting. But what I can tell you is our resource partners do pay attention to who's crowdfunding, what industries, what business models. There's a nice little map they've created that they've sent to me that has like the top 10 crowdfunders and kind of, you know, if you're this, then you move up this way and that kind of thing, because they are all different. He mentioned GoFundMe. GoFundMe really has two different products. It has loan products and it has kind of grant products where they just give you money if you can sell your story well enough. There's equity crowdfunding, there's loan crowdfunding, and then there's kind of grant crowdfunding. You may be able to get grant crowdfunding if you find the right place, and that would be the best source you could get. But in terms of crowdfunding, it's huge, it's accessible. They don't underwrite the same way that traditional banks do. It's more about selling your story, so it could be a way for you to access a lot of capital, maybe even all you need from a single source. So it's something to be looked into, but you would need to vet those organizations and read the fine print and so on if you were going to enter into one of those.
Is it traditionally quicker?
Yeah, definitely. Get an SBA loan, it's gonna take you months to get that. It's a 3-minute video, you post it up, you gotta qualify, I mean, it's fast.
This is probably a good time to do a good warning. Be careful of quick. In the crowdfunding space, I think there's some really good things out there. But in the online lending space, be careful of quick. If they're trying too hard to get you in a loan, be careful about getting in a debt trap. There are some responsible online business lenders out there. There are some that are not so responsible, but even the responsible ones are charging 30-40% interest. So be careful, and they'll find you. You don't need to look for them. They will find you. We've refinanced a lot of that debt. I'm sure Roberto's seen some of that as well. Some of them we can't refinance because it's not even an interest rate, it's a fee you paid up front and you're gonna pay it regardless. So if we refinance you out of it, you're still paying the total financing fee up front, right? So it wasn't even how long you had the money. So be careful with that, and if you do end up in a situation where you're dealing with an online lender, make sure you do your homework, your due diligence, understand all the fees that are in place, because quick oftentimes has a price to it. So and having said that, I think that lenders like ourselves try to get you through a lending process. The smaller the loan, the easier and quicker. Accion's probably the fastest in getting a loan under $20,000. Our process on larger loans can be anywhere 4 to 6 weeks, and oftentimes that's after receiving all the information we need. So sometimes a loan can take us 3 months, but part of that is because the financials weren't there, and the business has to go back and hire a CPA to help put the financials together in a way that we need it. From an application decision, we can move at the speed that you need us to.
Just to clarify as well, the online lenders, in my mind, are a totally different world than crowdfunding.
Okay, yes.
What, as a CPA, I guess, what type of financials do you typically like to see? Do you prefer compilations, honest reviews, or what's kind of your requirements for a business?
Great question. And depending on the loan amount, for example, if it's something below 50,000, we'll look at year-to-date financials. It could be in-house or company produced. If we see errors, if we see things that, of course, are out of whack, we're going to look for maybe a compiled financial statements, and that's where we can work with the partner or CPA or client CPA in order to get compiled financials. And that's typically on loans up to 100,000. If it's over 100,000, then of course we will look more into more formal financials, right? If they look right, we'll work with that. But again, if there's some errors, compiled financials is typically the way to go. I think I've only had one situation where we're asked for audited financials. But yeah.
You said you're a CPA?
Yes.
So, awesome question, right? I think a lot of what we see are inconsistent financials. We see folks that, hire an accountant, and oftentimes the accountant does them injustice, and so you could probably, there's some folks out there that aren't doing a job, I'm sure, that as diligent as you are, and so when you identify an accountant, or CPA, make sure you check references on them. Make sure that, if they've been able to get loans through a bank using that, they probably have an accountant that knows how to put the financials together in a way, because that past history of other clients getting, financing is going to be a testament that, we can look at their financials and make sense of them, right? But there's a lot of folks out there that, have the accountant title, but aren't necessarily, providing, good, solid, accounting statements for us to look at. And then, if you ever change, accountants, and you upgrade to somebody who's going to do things, better and more true, then make sure that you're able to tell that story. We oftentimes will see 3 years financials, and there's such significant shifts. That might be because of the way cost of goods was treated and so forth. And so you want to be able to, get your new accountant to explain, what the previous accountant wasn't doing correctly. And if you get that in writing, that's great, because that's going to help you in the long run to help to explain to a lender, what changed so dramatically in your business, and oftentimes just the way that you're accounting for the business, and not necessarily that there was dynamic shifts in the business.
Does anyone here do business with the federal government or looking forward to doing business with the federal government? Okay, like 8A or lump sum program, any of those? Okay, so with the SBA, if you're 8A or any of those programs, there's 3 levels. Below $1 million, I'm not sure what's required to remember. Below 10 million, you do a compilation. Over 10 million, you have to do an audit. So they force you, the SBA forces you to tighten up your financial reporting, which helps you when you want to get a loan or bond or any of those. So, just to let you know. So, again, it's expensive, of course, to do an audit, but it puts you in a better position when you look into to get a loan, of course.
Like the audit's like $10,000.
No, it's like 30, 40,000. Yeah.
But again, he's talking about to get $10 million
Yeah.
contract.
Right.
So when you want to hope that you get to a place where you're going to pay $30,000 for it.
Yeah, right. You're doing all right. You're doing all right. But a compilation is cheaper, right? Yeah.
Any other questions from the audience?
May I have a business card from each one of you?
And I believe our panelists are going to stick around for our speed networking event as well. So right after lunch, you'll have an opportunity one-on-one with anyone else. You guys are right on time. That's it.